What is a surety bond? A surety bond is a contract between three different parties: the principal, the surety company, and the obligee. The principal is the individual or business entity who is purchasing the bond. The surety company issues the bond to the principal and assumes financial responsibility on all claims made against the bond, while the obligee is the entity requiring the bond and is usually a government agency. A surety bond guarantees that the principal will act in accordance with the terms established by the bond, which are usually a set of statutes or ordinances required for business licensing or performance of contract terms. Unlike insurance products, surety bonds contain what is known as an indemnity agreement. An indemnity agreement means that the principal is legally liable to repay the surety company for all losses resulting from claims made against the bond. Indemnity agreements also require the principal to repay the surety company for any legal fees and claims handling expenses. There are many different types of surety bonds, thousands to be exact, but most surety bonds will fall into one of the following categories: license and permit, contract, court, fidelity, and miscellaneous. Surety bonds aren't designed to protect the principal. Surety bonds do not protect the principal, but rather they protect the obligee from financial harm resulting from actions committed by the principal. Claims made against a surety bond are completely avoidable. As long as the principal follows all conditions laid forth in the bond, then they shouldn't have any claims made against them. Generally, these provisions are set forth to prevent the principal from engaging in unethical actions such as defrauding customers or not paying required taxes and fees. If surety bonds didn't exist, then how would the principal be able to guarantee that they would fulfill their bond obligation? The principal would need to post 100% of the bond amount in the form of a cash collateral or an irrevocable letter of credit. Depending on the bond amount, this could severely decrease the principal's working capital and liquidity. A surety company provides, in essence, a line of credit to the principal. For a small percentage of the bond amount, the obligee's need to transfer the risk is met, and so is the principal's need to hold on to liquid cash. So how can an insurance agent obtain a surety bond for their customer? Bond exchange makes obtaining a surety bond easy. Insurance agents need to simply log into their account and search our database to find their bond. Don't have a login? Enroll now by going to bondexchange.com and clicking on that big blue Get a Login button, and let us help you satisfy your customers' needs. If you enjoyed this video, make sure to subscribe to our channel as we post weekly content helping insurance agents effectively obtain surety bonds for their customers.